Hey everyone, and welcome back to the channel. Today, we're diving headfirst into a topic that's been buzzing everywhere. You've probably heard words like Bitcoin, Ethereum, or blockchain. But what do they actually mean? Is it real money? Is it safe? And how does it all work? By the end of this video, you'll have a solid, easy-to-understand grasp of the crypto world. We're going to break it all down, step by step. No confusing jargon allowed. So, grab a coffee, get comfortable, and let's demystify the future of money together. First things first, what exactly is cryptocurrency? The simplest way to think about it is digital money. It's a form of currency that exists only online. There are no physical coins or bills you can hold in your hand, like dollars or euros. It's designed from the ground up to be secure and, most importantly, decentralized. Now, that word decentralized is key. Let's think about how traditional money works. When you send money to a friend, you usually go through a bank. The bank is a central authority. It verifies the transaction, moves the money from your account to theirs, and keeps a record of it. This system works, but it means we have to trust these central institutions, the banks. The governments do manage our money correctly, not charge crazy fees, and keep our data safe. Cryptocurrency flips this model on its head. Instead of one central authority, it's run by a vast, global network of computers. No single person, company, or government is in charge. This is the core idea of decentralization. It means power is distributed among all the users, not concentrated at the top. This design aims to create a more open, transparent, and fair financial system for everyone. So, when you hear crypto, think digital, online money that isn't controlled by a single bank. So, if there's no bank, how do transactions actually happen? And how do we know they're secure? This is where the magic of blockchain technology comes in. A blockchain is basically a digital ledger, like a giant public accounting book. Every single cryptocurrency transaction is recorded in this ledger. Imagine a chain made of blocks. Each block contains a list of recent transactions. When you send crypto to someone, that transaction is bundled together with others into a new block. But before this block can be added to the chain, it needs to be verified. This verification process is done by thousands of computers on the network, all working to solve a complex mathematical puzzle. This is often called mining. Once the puzzle is solved and the transactions are confirmed as legitimate, the new block is officially added to the end of the chain. And here's the crucial part. Once a block is on the chain, it's permanent. It cannot be altered or removed. This is because each block is cryptographically linked to the one before it, creating an unbreakable, chronological chain of events. That's why it's called a blockchain. This public ledger means everyone can see the transactions that are happening, which creates incredible transparency. But don't worry, your personal identity isn't attached to it. Transactions are pseudonymous, linked to a digital address, not your name. The crypto part of cryptocurrency comes from cryptography, the advanced encryption that secures this whole process, making it extremely difficult for anyone to cheat the system or spend money they don't have. So, in short, blockchain is the secure, transparent, and unchangeable record book that makes cryptocurrency possible. Now that we know how it works, let's talk about some of the big names you've probably heard of. The king of them all is, of course, Bitcoin, often abbreviated as BTC, launched in 2009 by the mysterious Satoshi Nakamoto. Bitcoin is the original cryptocurrency that kicked off the whole revolution. It introduced the world to the idea of a decentralized digital currency and blockchain technology. Its primary purpose was to be a peer-to-peer electronic cash system, a way for people to send money directly to each other without a bank. Because it was the first, Bitcoin is the most well-known and, by market value, the largest cryptocurrency today. Many people see it as a form of digital gold, a store of value that is scarce and resistant to inflation. Next up is Ethereum, or ETH. Ethereum took the basic idea of Bitcoin and expanded on it in a huge way. While Bitcoin is mainly focused on being digital money, Ethereum is more like a global, programmable computer. Its creator, Vitalik Buterin, envisioned a blockchain that could do more than just record transactions. He wanted one that could run code. This led to the creation of smart contracts. A smart contract is just like a regular contract, but it's a piece of code that lives on the blockchain. It automatically executes the terms of an agreement when certain conditions are met. For example, a smart contract could be set up to automatically release payment to a freelancer once their work is submitted and approved. This programmability has made Ethereum the foundation for thousands of other crypto projects, including what's known as decentralized finance and NFTs. Finally, we have stakes like USDT, which is Tether, and USDC, which is USD Coin. One of the big criticisms of cryptocurrencies like Bitcoin and Ethereum is that their prices can be extremely volatile, going up and down dramatically. This makes them tricky to use for everyday payments. Imagine buying a pizza for what you think is $10, but by the time the transaction goes through, the price has dropped, and you've actually paid $12. Stablecoins solve this problem. They are designed to be pegged or tied to the value of a real-world asset, usually a major currency like the US dollar. For every one USDT or USDC in circulation, there is supposedly $1 US held in a bank reserve. This keeps their value stable, at or very near $1. They provide the stability of traditional money with the flexibility and speed of crypto, making them incredibly popular for trading and transferring value without the volatility. So, we have all this amazing technology, but what are people actually using it for? Well, the use cases are growing every day. One of the most common uses is simply as an investment. Just like people buy stocks or gold, many buy cryptocurrencies hoping their value will increase over time. They see it as a new, high-growth asset class. This is also called trading, where people try to profit from short-term price movements. Another huge use case is for online payments and international money transfers. Sending money across borders with a traditional bank can be slow and expensive, often taking days and involving hefty fees. With crypto, you can send value to anyone, anywhere in the world, in a matter of minutes, often for a fraction of the cost. This is especially powerful for people in countries with unstable local currencies or limited access to banking. But perhaps the most exciting area is decentralized finance, or Remember those smart contracts on Ethereum we talked about? Developers are using them to build an entire parallel financial system on the blockchain. Think lending, borrowing, insurance, and exchanges, all without traditional banks or financial intermediaries. DeFi aims to make financial services more accessible, transparent, and efficient for everyone. You can earn interest on your crypto holdings, take out loans using your crypto as collateral, and trade assets, all directly from your digital wallet. It's a brand new frontier for finance that is being built right now, and it doesn't stop there. People are using crypto to fund creative projects, build decentralized social media platforms, where users control their own data, and create new forms of digital ownership with NFTs. The possibilities are truly expanding all the time. Okay, we've talked a lot about the exciting potential of crypto, but it's absolutely crucial that we also talk about the risks. This is not a get-rich-quick scheme, and you need to be very careful. The number one thing to understand is volatility. Cryptocurrency prices are famous for their dramatic swings. It is not uncommon for a coin's value to jump or fall by 20% or more in a single day. This means that while you could make a lot of money, you could also lose a lot very quickly. You should never, ever invest more than you are willing to lose completely. This isn't like a savings account. It's a high-risk investment. Next, you have to be extremely vigilant about scams. Because the space is new and largely unregulated, it attracts a lot of bad actors. You'll see fake projects promising guaranteed astronomical returns. ULLC phishing scams, trying to trick you into giving away your personal information or access to your funds. A common rule in crypto is, if it sounds too good to be true, it almost certainly is. Always do your own research on any project before investing. Check out their team, their technology, and what the community is saying about them. Trust your gut, not random ads or influencers. Finally, and this is one of the most important concepts in crypto, is the idea of not your keys, not your coins. When you own cryptocurrency, you store it in a digital wallet. This wallet is protected by a long, complex string of words and numbers called a private key. This key is like the master password to your bank vault. It gives you, and only you, access to your funds. If you lose this private key, you lose your crypto forever. There is no forgot password button. There is no customer service line you can call to get it back. It will be gone. This is why self-custody comes with great responsibility. You must keep your private key or your seed phrase written down and stored in multiple, secure, offline locations. Your security is in your hands. So, how do you get started if you're still interested after hearing all that? The most common entry point is through a centralized cryptocurrency exchange. Think of these as the stock brokerages of the crypto world. Companies like Coinbase, Binance, Kraken, or Gemini are platforms where you can use your regular money, like US dollars or euros, to buy, sell, and trade cryptocurrencies. Getting set up is usually pretty straightforward. You'll create an account, and just like with a bank, you'll need to verify your identity by providing some personal information and a photo ID. This is for security and to comply with regulations. Once your account is verified, you can link your bank account or debit card and deposit funds. From there, you can browse the market and buy your first fraction of a Bitcoin, some Ethereum, or whatever other coin you've researched and feel comfortable with. These exchanges make the process very user-friendly. They handle a lot of the technical complexity for you and store your crypto on your behalf. While this is convenient, remember what we said earlier. Not your keys, not your coins. When your crypto is on an exchange, you are trusting that exchange to keep it safe. For beginners, this is often the best place to start. But as you become more experienced, you might want to learn about moving your funds to a personal digital wallet where you control the private keys yourself. This gives you full ownership and control over your assets. We've covered a huge amount of ground today, so let's do a quick recap. Cryptocurrency is digital money that is secured by cryptography and operates on a decentralized network, meaning no single bank or government controls it. This is all made possible by blockchain technology, a transparent and unchangeable public ledger that records all transactions. We talked about the big players: Bitcoin, the original digital gold; Ethereum, the programmable blockchain that powers smart contracts and DeFi; and stablecoins like USDT and USDC, which are pegged to the dollar to avoid volatility. People are using crypto for everything from investing and trading to faster, cheaper international payments and building a whole new decentralized financial system. But we also stressed the importance of being careful. The market is volatile, scams are real, and you are responsible for the security of your own funds, especially your private keys. The world of cryptocurrency is complex, fascinating, and evolving at an incredible speed. It represents a major shift in how we think about money, ownership, and trust. It's not just a new type of asset, it's a whole new layer of technology that could reshape industries. Our goal today wasn't to convince you to buy crypto, but to give you the foundational knowledge you need to understand the conversation and make your own informed decisions. Continue to be curious, keep learning, and always be cautious. Thank you so much for sticking with me through this deep dive. I hope you found it helpful and that it cleared up some of the mysteries surrounding crypto. If you enjoyed this video and want to learn more, please hit that like button and subscribe to the channel. Let me know in the comments what you'd like me to cover next. Thanks for watching, and I'll see you in the next one.